off the charts if you are taking time off. I know there's a couple days off this week you couldn't have traded, so yeah, I hope you guys have been enjoying that. We're getting right back into it with another case study on euro. This is a trade I took nearing the end of December, coming into the Christmas break. So there's two entries I took, both swing type of positions where I held for a longer period of time. So we'll cover these guys here. So I can just rewind it to like this area here, which is the end. Yeah, this is right before Christmas break, so December 22nd. But yeah, okay, so start off on the higher time frames here, just to get an idea of what I was looking at. So we talked about this a couple times, but big sell-off here, sweeping these lows, taking that liquidity. Went a lot deeper than I actually thought it was going to be. I thought we were going to trade into this imbalance here, right? Just tap in and then move away. But we needed to wait for that current price action to tell us that story, right? Tell us that confirm to us that we can go up. And what gave that to us was when we had this run on this liquidity on these highs, and then price came back down to trap those buyers. So now those buyers are taken out of the market, right? With this move here, run on those buyers, those early buyers are taken out. And then if we go to the 15, all right. So here we trap those buyers, okay? Again, because we've taken out this high, they think break is structure, so everybody's going to be buying these areas on the way down, right? And then we end up sweeping those lows, okay? We get a sharp reaction back up, reacting to these highs, just leaving equals, which is now giving us hints, right? And then run lower. This would have been a gorgeous swing position. I wasn't on the on the charts for this day, but we run this internal liquidity here, leaving us a nice liquidity block. Just like this, right? And we tap that liquidity block after we check this out. After we trap buyers, pretty sure I covered this, but we'll just go over it again. Trap those buyers, tap that liquidity block, and we move away. Okay, cool. So now continue along with price. My entries came. What's the 1 hour? Yeah, a little further in time. So up here, so we ended up going bullish. This is where we marked out this area. Again, this is after the extreme. We trapped those buyers, tapped into these areas to the left, and then look how we squeeze, because we're reacting to these areas over here to the left, inducing sellers to get into their seller positions. So it's just gonna keep adding liquidity above these highs here, right? That's why FOMC, I believe this was, big move to the upside, sweeping those highs, and then we continue off. Then we come to these highs, run the inducement high, but we respect that structural point, right? Where sellers are looking at selling this thing from. So this reaction from A to B essentially was just false to engineer liquidity above the high. So I can just, what we'll do is we'll mark this high. This high here is just engineered liquidity, okay? So we purposely reacted to this area here just to build more liquidity above this high, all right? So now we're getting closer to the entries I took. We get this sell-off. This is the end of the week on Friday. We get the sell-off, and then we start taking these internal points here, 1 and 2. We'll go to the 5 because I believe that's when it starts making more sense here. Perfect. Okay. Actually, you know what? Let's go back to the 1 real quick because I want to mark out this area I had marked. Okay, so you can see this liquidity block area. Ran that internal point here, and then we went bullish and never returned. What do we have right above the liquidity block? An inducement low, okay? Look how price respected this high to the left, printed us this low. So essentially anywhere below this low means now we're trading in this liquidity block. So we can see price run away from that. And that's exactly what happened, right? We run this inducement low in this whole area. I can actually just mark it like this. This whole area here is essentially a liquidity block. Okay, so anywhere in here we could respect and move away from. And that's exactly what happened. So let's go into the 5, break down the price action within that area. Okay, so first, our initial reaction, we get this big sell-off. This is on Friday coming into New York. And then we start tapping into some areas on the left, giving us some false reactions. Look how we get a push up, taking out this high here, this internal point, which means we now want to see this low taken, okay? Not only this low taken, but we still want to see this area get tapped into, right? The area that we marked out from the left-hand side, this blue box. So we trap those buyers here on M5, but we still keep getting some false reactions, still building liquidity from the areas on the left. And then finally we tap into this area. It's late on Friday, so this is when I shut down. I didn't shut down here. This is 2 p.m. So this is like 2-3 hours after the time I usually shut down. But this is when like you don't want to be looking at the charts anymore, right? So it's end of the week, 11 o'clock, 12 o'clock on a Friday, Eastern Standard Time. This is not a good time to be looking. So I shut down the computer this day, come back on the Monday. Since we have now printed this low, we can expect price to move bullish. And this is exactly what happened, right? So let's dissect this price action here. I believe we covered this trade actually, but it was more of an intraday target trade. So we'll cover it again real quick though. Doesn't hurt to. But we take out the highs here to the left, right here. This is in London. Just to go over this quickly, we get a nice pullback, mitigation of this extreme here. We get the sell-off, taking out some internal lows. Okay, then price goes bullish again, taking out these highs here. But we failed to do anything on the left. We're still trading this imbalance. So every time, you got to think about it, every time we tap into these areas, this area here, or anywhere in the imbalance, or these areas up here, these are just going to be false reactions from sellers getting in the market, okay? So what does that tell me? Every time we get a false reaction and it aligns with a buy position, it's just another buy. And that's exactly what happened. We have price coming down to this liquidity block down here that I had marked on, okay? And why did I end up choosing this one? Well, you can see, look how we get that sell-off from the highs. We respect this area to the left. And as we know, we need to see that build up occur first. So we let the liquidity build, respect this area, come up, respect the highs. Now we got liquidity at the highs, perfect. And then we take out the liquidity, tap the liquidity block down here, and move away. So that was my first entry. Here, stop goes below. And then we're targeting. So actually what I did was partials here. Okay, so we'll leave this black line on there to let us know that that's where I partialed. And then we have our overall target from the higher time frames up here. Okay, so that's first target. Oh, sorry, excuse me, first entry. Then this was on Monday. I believe my second entry came, yeah, it was later on the week, so on Wednesday. Okay, cool. So let's go back to the 15. Okay, so now we can kind of see what's going on here. Look how price is just squeezing here. So you gotta think of this from a retail perspective, where they see price as momentum based and all this kind of thing. So they see bullish price action as being dead, right? No volume, no momentum. So that's why they're going to be selling this area here. They're going to be selling these areas here because then they're going to be like, oh, look at all the liquidity we've built here. So we're going to be targeting these areas, but that's dumb money. Okay, they fail to realize that we've just left liquidity at the highs. This whole move from A to B was essentially just false. Okay, this is just to induce sellers in the market because now every time we approach these areas, there's going to be sells. But look at all the liquidity we left at the highs. So it's all fake. All right, it's all false. So coming into this is Tuesday, late New York. I didn't take the trade this day. There it was on Wednesday. Okay, so we sell off. What do? We actually react to these highs to the left. Again, what does that tell me? This move is false. Okay, because look at the liquidity we have to the upside here. So if we get reactions, we know that price doesn't just respect these areas and just go bearish. Okay, doesn't work like that. When we respect these kind of highs here, where there's liquidity sitting above, it's just going to be engineered liquidity. It's just telling us that we're going to respect here temporarily, okay, but it's all done on purpose for then us to target. Okay, so my entry, we sold off here, okay, and then we respected this area to the left. Use a red box again here. Okay, Then we get a big reaction to the upside, taking out some internal highs. What does that tell me? Buyers are now induced. So we want to see what taken. Boom. Okay, because look, if buyers are trying to get in here, where their stop loss is going to be right below. Okay, they get put into profit. Not only do they get to put into profit, but when we take out these highs, now we're going to have traps here. That's exactly what happened. Right here at Wednesday, coming to the end of New York, we trap all those buyers. Okay, how can we take advantage of that, and how can we get into the market? So this entry ended up coming, yeah. So this was in London. I ended up setting a limit before bed in Asia. Now, how did I go about doing that? Let's go to the 5 here. Okay, so I saw that we swept that liquidity here, and I said, perfect. Now we just need to wait for current price action to give me some sort of entry. So saw price come back up to this inducement high, respect it a little bit, printing these inducement lows here. But before we took the high, look what we did. We printed high, low, high, low. Now we got what? Liquidity. Okay, and then we take the inducement high. Oops. Then we take the inducement high. Okay, and price comes back down and does what? Respects this like structure again. So now it tells me we got a ton of liquidity down here. I want price below this low. Okay, and if I go to the 15, we'll get like a more precise marking here. So I marked this low here. Why? Because again, anywhere below this, there's going to be imbalances in the lower time frame here, but essentially anywhere below this 15-minute low is that liquidity block. So I'm interested in price just running this low, tapping wherever it needs to tap. I don't need to find the exact point, right? So anywhere below that low is good. We take that buy at that low. Stop goes below the liquidity block, so 7.5. We can go 8, just like that. Right? Look at the precision on that. What you can also see London did for us, just as an added influence. Look how we induced higher. So what does that tell me? Buyers are now induced in the market. They get trapped here. Okay, look how we trap those buyers. We get a pullback, mitigation of the extreme. Here, this is going to be a build-up for us. Here, that's exactly what happens. We react off this area temporarily, all on purpose, because there wasn't sufficient liquidity to the downside yet. We run those buyers, take all that liquidity out, mitigate the extreme, tap that liquidity block. Right, liquidity block being down here. So we tap that liquidity block, this area, again, anywhere below that low. We can go to the 5 and actually see what imbalance it ended up filling. We can't even see a 5, maybe on the 1. That's why you don't need to pinpoint the perfect imbalance sometimes. All you got to do is find like that last point of liquidity, that last low. Look, did we even tap into it? Yeah, we actually didn't even tap into the 1 minute imbalance. So look at that. We actually left perfect equals. But yeah, not that important. Again, maybe it just mitigated something over here on like the 30-second. That's why I like to go up a couple time frames, excuse me. Find that last low essentially before that liquidity block. Then again, anywhere below this low that's printed at 415, anywhere below that low is valid, right? We could tap into any of this area in the liquidity block and just run away. And exactly what happened here. You can see even on the 15-minute, we get that nice reaction and then a tap of the liquidity block here. Boom, and then just explosion in London. Again, look how we come back up to these highs, temporarily respect the highs. Again, engineers more liquidity, and then finally we blast through. So yeah, the 2 swing entries here, all based off, remember, don't forget the higher time frames. This sell move was just false, right? So now all these areas are going to be smart money traps. Again, false reaction here, just to induce sellers. Again, look at this. Engineered liquidity provides us another buy entry. Same thing over and over and over. All right. So I hope you guys enjoyed this case study. Maybe it's one of those you want to watch twice, take some notes. But yep, New Year is around the corner.